Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hello, everybody. Welcome back to the Get Real Podcast. Ron Phillips here. Man, for this time of year, which, it doesn't really matter what time of year it is, although you can tell because I'm in short sleeve, and if you can't, I'm telling you, it's gorgeous in Charleston. About 85 degrees, the sun is shining, and people are taking advantage of the equity in their investment properties. And that's what I want to talk about today. Really pretty cool that, if you don't know, let me back up a step. I think people don't realize sometimes just how impressive the equity growth in a property can be between someone paying down your principal for you, that being your tenant in your property, and the appreciation of a property. Those two are creating an equity spread in your properties. And a lot of people don't take advantage of that over time. Just kind of forget about that, and we only focus on the cash flow, and years go by. We talk to people all the time who have literally hundreds of thousands of dollars sitting trapped in their property. I say trapped. It's just parked in there like it would be in a bank account or somewhere else. Not as liquid as a bank account, but you understand what I'm saying. The idea of investing in these properties is that ultimately they begin to spawn or birth new investment properties without you putting any more of your own money into the deal, right? And so if you bought a property for a couple $100,000 and let's say 7 years has gone by, property's now worth $400,000, you have $200,000 in this property, it's just sitting there. We've talked about return on equity before, so I'm not going to go into return on equity. What I want to talk about today is the difference between 1031 exchange and refinancing. And I want to talk about, something that you may not have heard of, which lends itself to helping people refinance, where most people right now aren't super jazzed about that. Okay. So 1031 exchange, really briefly, I'm not going to get into, I have shows on 1031 exchange you guys can go back and listen to. 1031 exchange is when you are selling an asset, and rather than taking the cash, you put the cash into an exchange, and that exchange, then you go buy more assets with the gain. Okay. And then you can defer your taxes to a future state, right? So that one property can then buy 2 or 3 properties, and you're not going to pay any taxes on that gain right now. You're going to defer them until later. Okay, that's the idea of a 1031 exchange. A lot of people doing that right now. Almost no one is doing is cash out refinancing, because most people have upper 3s, mid 4s, 5% mortgages. And right now the interest rates are, 7.25%. And nobody wants to double their interest rate to get cash out of a property, which I completely understand. I wouldn't want to do that either. So in steps this new product, because listen, lenders and banks, their whole job is to lend money. Sometimes it doesn't feel like that. Sometimes it feels like their whole job is to make it really difficult for you to borrow money. But that's not the case. Really, what they're trying to do is loan money. And because that's what they're trying to do, they're listening to the market. And the market is saying, look, I'm not trading my ridiculously good loan for your, higher interest rate loan so that I can pull money out. So I'm just not going to do it. And so they're keeping those properties, or they're selling those properties. There is a product out that you may or may not be aware of, and it is a cash out second. There's both a HELOC second and just a regular second. So you can keep the first mortgage at the ridiculous interest rate that gives you great cash flow, and you can put a second on. And these seconds are debt service coverage ratio loans. So you don't have to go through the rigmarole of getting approved personally, because as we've talked about in the past, debt service coverage ratio loans are specific to the property and how it performs. The other thing is a debt service coverage ratio loan won't allow you to take cash out of the property over what the property will perform, because by its definition, it is a debt service coverage ratio cash out loan. So this product, what allows you to do, a lot of people love their properties and they don't want to sell them because they perform really well. The tenants stay and they're just kind of good performers. They sit there and don't cause any trouble. Well, this allows you to harvest some of the equity you have in your properties, and it allows you to utilize that equity to go and buy more real estate, which is the whole point to begin with. Have more of these assets out there that are growing and increasing in value, having more tenants out there paying off your mortgage, having more cash flow, more tax incentives, more of all of what is great about real estate without having to put any more of your own money out there. Now, the growth rate of a portfolio where you continue to invest with your own cash as you earn cash and you set it aside, save it for investments. And a few years later, when you're able to actually continue to do that and also have these assets producing more assets is staggering, because each asset should produce at least 2 to 3 more assets in roughly 5 years, depending on the market, depending on on the market conditions. But if during those 5 years, you've continued to buy 1 or 2 or however many properties that you can afford to do every year, that means every year after year 5, your property should be buying you another asset. You're doubling or tripling what you are able to do on an annual basis because your properties are doing the same thing, if not more, every single year after year 5. And so your compound curve starts to really, really increase. It starts to really stand up, right? And it does that because of the ability to go and buy more properties out of that one property. So I wanted you guys to be aware of this because we do so many 1031 exchanges, and I think it still might be right for you. I'm not saying one is right or one is wrong. I'm just saying I just think most people don't know this even exists, and they haven't really taken a good look at how this can help them. Like, I don't know, you're listening. Have you heard of it? Have you thought about doing this? Or have you been thinking, well, if I do a cash out refinance, then I have to give up this 3.5% mortgage or this 4.5% mortgage for a 7% mortgage? Because if that's what you've been thinking, it begs taking a hard look at this and seeing if it is as good or better than doing a 1031 exchange. So that's what I just want to do a quick show today. And I wanted to introduce you to something that you probably haven't heard of. It's just based on internally in our office. I know people haven't heard of, and that's my fault. I know I haven't shared this on the show. It's a relatively new product. It's come out because, back in the day, you could just refinance. It's no big deal because you're refinancing at 4% for a 4%, no big deal. Now that interest rates have gone up, it is kind of a big deal. So anyway, if you want more information about that, you can email the show, invest@rpcinvest.com, and just reach out. We'd be happy to give you more information. If you're working with somebody already on the team, just call them up and ask them about it, and they'd be happy to run some numbers for you. And until next week, get out there and make something happen.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.